Hi, welcome. This is RN Bhaskar from BKBB, an acronym for Bhaskar Ki Business Baatein. That's a channel that comes to you with policy analysis, conversations, occasional business stories. But BKBB at 8:15 on Saturday mornings is a program that brings you news behind the news. And like every week, we have some very interesting headlines for you. At the same time, do remember to watch our latest podcast, which is on the coal sector, which unfortunately is something that is being derided when India and other developing countries may not have a choice but to respect coal. A podcast is given here. Do watch it. And again, a reminder, please click the subscribe buttons, the like button, and tell all your friends about us so that we can grow faster. And finally, let me introduce my co-anchors to you. There's Katya. Welcome, Katya. There's Janavi. And there's Saloni who'll join us later. Okay. These weeks have been tumultuous in many, many ways. Last week saw the US-Iran war being deferred for some time, though it can erupt anytime. The last week saw the Prime Minister going to Israel, which was quite worrying because Israel is a war criminal nation, and the Prime Minister of Israel, whom the Prime Minister of India hugged, is also declared a war criminal. And that sends out a wrong signal both to BRICS as well as the world. And let's go to the stories. Let's begin with the first story. And the first story is by Janvi. You have Gen Z spends more, but maybe not wisely. Markets tremble at AI plans. And the third one is, will credit defaults replicate 2008? Okay, Janvi, come in with the first story.
Yes, sir. So today we look at whether people in India are walking into a debt trap, or if we are witnessing some sort of a large household credit shift. So a recent report in Fortune India shows that young earners in their 20s making just about 30 to 40K a month are racking up debts of 30 to 40 lakhs. And this is borrowing at a scale that we typically associate with mid-career borrowers. So this one case study shows a 30-year-old professional earning 58K a month, but paying over 50,000 in EMIs. So after expenses, just about 2,000 remains for savings, and the debt stack includes home loans, personal loans, credit cards, even gold loans. And this isn't just an isolated case. So data suggests that 46% of new to credit consumers are under 35. So basically, younger Indians are also the fastest growing borrowers. So now Dutch economists are flagging a structural debt shift in India. So household borrowing is rising even as wage growth remains uneven. According to RBI, the unsecured retail lending has grown sharply in the recent years, prompting regulatory tightening, and microfinance stress has also really gone up. So, what exactly is driving all of this? First of all, easy digital credit. You have instant approvals, multiple fintech apps, buy now, pay later schemes. Credit has become really frictionless. And then you have aspirational consumption, homes, gadgets, travel. So people are not really waiting for long term saving cycles. And third is that debt has really started to be normalized. So it no longer carries the stigma it once used to. It's just become something that gives you access to the kind of lifestyle you want. And so if unsecured lending keeps expanding faster than income growth, if a small percentage of borrowers of these young borrowers face job disruptions, then the effects could also hit the the NBFCs and microfinance institutions. um, so India's overall household debt to GDP ratio remains lower than most developed economies, but the speed and composition of this growth is really fast. So the question isn't really whether people are, you know, borrowers are responsible enough, but it's also about lenders underwriting aspiration without fully pricing the risks. So, what are your thoughts on that, sir?
Thank you very much, Janvi. It's a worrisome thing. On the one hand, we want consumption to grow, but we want sensible consumption and not a overheating of debt. On the other hand, with the job market shaky, notching up debts and EMIs is frightening because it'll disrupt lifestyles, families phenomenally. Katya, what's your view about it?
So that's a very clear trend, sir. So you cannot blame a 22-year-old for taking a loan, so especially when every app, every bank call is actually goading them to take loans. Okay, point number one. Point number two, if you remember, a lot of banks have reduced the corporate loans extensively. In fact, a lot of during the bull run cycle, a lot of people paid back their corporate loan debts, which means banks are flush with cash, which they are flush with loanable amounts, which they're pushing onto them. Not just banks, via NBFCs, via apps. There is and all of this is not going into creating assets. It's going into, you can buy a phone, you can buy even hair straighteners, everything, BNPL kind of spending, which is all going into this. So the Dutch economist that we spoke over, he said this growth in disposable income we are talking about, is it all debt? And which is a very valid question. Obviously there's no way to know it, by correlation of data, but his question is a very valid question. And two, it is very irresponsible for banks, for people, lending institutions, to push loans to people that they may not repay. Like for example, person who's making 30 to 40,000 should not be given a loan of 30 to 40 lakhs. We should also study how civil scores are going down because of this. It's because loans are being pushed onto people. So when you spend a big ticket amount, the bank itself will call you and ask you, can you convert it into a loan? If I have the money, I'm spending it. Why are you calling me back? So this is extreme irresponsibility in terms of banks. It is their way of growth, credit growth, which has only come from retail lending, sir, in the last 3 to 4 years. Corporate lending, as in fact, SBI head has also said that, people are repaying corporate loans earlier than usual. So that is the whole story for you.
Yes, it's worrisome, and I don't know which way we're going to be heading. But let's take the second story. There's Saloni who'll come in with the second story. Saloni, come in.
Yes, sir. So NASSCOM has said that India's IT companies are expected to grow only around 6% this year. The industry body cautioned that the impact of AI is real and that growth could remain flat for IT outsourcers for at least next 2 to 3 years. It also projected that fresher hiring by these firms among India's largest mass recruiters would remain flat as automation reshapes tech-related jobs in the country. All of this could result in mixed fortunes for IT services companies in the near term. But chairmen of companies like HCL Tech, Infosys, and TCS have refuted claims of such fears. They also said that such transitions have happened before. AI will have what kind of impact on IT sectors that can't be told now, but the markets have started to react. Since 1st January, IT stocks have been on a free fall. Until 16th February, the sector's market cap shrank by nearly $45 billion. On Wednesday, many of them recovered slightly after comments from Anthropic implied partnerships with tech and software firms. This prompted a reversal of fortunes in US tech stocks. India's top 6 IT firms recovered 1 to 3%. They will also have an impact on index mutual funds. So, Indian MFs track a stock market index like Nifty 50 or Sensex. So, if there is a change in these indices, index mutual funds also change similarly. So, for now, the stocks are falling, so the index mutual funds also experience a short term fall. So, if everything is falling, what exactly is rising? It is AI revenue. Accenture posted advanced AI revenue of $1.1 billion in 2024 to 2025. while TCS said on December it earned $1.8 billion in annualized revenue from AI. Most stakeholders believe AI led automation will definitely have a detrimental impact on large deals, revenue growth, and headcount addition. Firms right now are putting up a brave face saying no enterprise will deploy AI by itself and will need IT firms for backward compatibility and compliance. For now, they are partnering up with top AI firms worldwide, which means they could stabilize after 2 to 3 years, by which time AI itself will likely to be more mature. What's your thoughts on this, sir?
Well, everyone knows that AI is going to bring benefits, and it's also going to meet a lot of job losses, at least initially, till new types of jobs come in. For India, it's worrisome because India is already facing an unemployment problem. And unless India goes about it carefully, and large players are responsible players, they will try to make sure that the disruption is not too great. But market demands are market demands. So one doesn't know where it'll go. What do you think, Katya?
Sir, it's very interesting. The Citron report has caused this crash, which has already crashed last week. Since February, IT stocks have been crashing. But what that Citron report paints a very doomsday picture about a cycle of how, AI will hit jobs and then consumption and then the productivity growth they will come in, is going to be moot. So, but what will happen with the IT sector is the NASCOM vice president made a very interesting statement. He said, AI will come in, but the size of the project, which was once $1 billion, will truncate to $100 million. If that happens, then the behemoths who have scores and scores of people working for them, that will not be necessary. So that is what India has been bringing to the table: cheap labor in terms of IT engineers. That USP actually will go away, but that is not playing out currently. What is currently playing out is their traditional business, which is what 80% AI revenues are rising, 80% is falling, and AI revenues are rising at a very, very fast rate, but they are not rising fast enough to make up for this fall. So they are stuck in that zone. So, a lot of experts have said that, a lot of research reports have said for the next 2 to 3 years, we all have to wait and watch. No growth is expected. 6% by NASCOM is actually very optimistic, if you ask me. So,
No, you're right. And that's why it's going to be scary. And India, I don't know whether policymakers are aware of the turbulence that it's going to create. But
right.
let's see. And that takes me to the third story, which is very interesting in a different way. Remember Jamie Dimon's statement just a month ago, or maybe 1 month and a half ago, about cockroaches in the market? He was talking about companies that had defaulted on loans. There was a credit default, and he said that was a cockroach. Why did he call it a cockroach? Because where there's one cockroach, you'll have 100 others, which are invisible at the moment. And that is coming out to be true. At least two companies have failed to repay loans. There could be many more. But more worrying is the other factor, that beside this credit default is a national default on the part of USA. The 9 trillion it has to pay back this year will not be automatically rolled over. Fund managers are going to demand a higher coupon rate. Worse is the US inability now to bridge the deficit with collections from tariffs. The Supreme Court has said the tariffs are illegal. And no matter how brave a face that Trump may put up and say, yes, I will still go ahead, I've got a 15-month window. The fact is, the resistance to tariffs has already begun. And if money does not come in through tariffs, the US deficit is going to widen even more, which means interest rates go up even more. And if interest rates go up, if coupon rates go up on bond markets, you'll have more defaults. You could replicate a 2008 financial meltdown situation in such a way that even 2008 might look just a small splash in the water. The fears are great. The US expenditure on war is frightening. It's worsening deficit. And its sanctions are killing trade. The US has been the culprit. The US is becoming a victim, both together. Look at the confidence indicators brought up by Bloomberg, and they all seem to suggest that everyone is jittery. Okay, let's see what happens. But Katya, do you have anything on this?
So mostly it's an unwinding of the software services model, which is also adding to the private defaults. Or apart from the macroeconomic thing, they are heavily, there's a huge unwinding of this sector, and which will also cause catastrophic. So AI is not going to hit one, like you said, it will hit the whole domino line. So, and that
Yes.
I think is starting to happen.
And with the US debt and with the coupon rates going up, one doesn't know. But
Yeah.
thanks, Katya. And this ends our week today. Have a lovely weekend. Have a very profitable week till we meet next Saturday. Do tune in because we'll bring you more titles, more analysis, more news behind the news. And remember, please click the subscribe button, the like button, and tell all your friends about us. And do watch our podcast. That is going to be very interesting because it just exposes a lie that the world is talking about why coal should be shunned. Developing countries cannot shun coal. And finally, take care of yourselves, enjoy yourselves. Good luck, goodbye.